Hello everyone, it's none other than your boy Chartmaster here. I welcome you all to Chartmaster FX. Today we are going to look at compression combined with liquidity, which is abbreviated as CPLQ. This is one of the price approaching strategies that we use at Chartmaster FX. It is one of our strikers that is responsible for scoring goals and making sure that the setup doesn't fail. So in order for you to have a full comprehension of this standard operating procedure, you are obliged to go and watch the compression video first, since it's more of an extended explanation of compression. So you need to first understand compression. Once you understand compression, then you can be able to understand compression combined with liquidity. This is one of the complex price approaching strategies, and it takes experience in order for you to master it. You need to develop as many flashcards as you can so that you get familiar on spotting the right compression that is combined with liquidity. So yeah, you need to put the work. By experience, you see that compression combined with liquidity is one of the powerful tools that you can be able to use in order for you to increase your precision as far as trading is concerned. So this is the anatomy of compression and liquidity. So the first thing, guys, that you need to do is to identify the historicity of your chart. Look in the past. We believe that past movement of price influence the current price structure. So the first thing that you need to do is to identify a supply that is strong. Once you identify a supply that is strong, then you wait for the price to make a compression. Once the compression is over, you see a liquidity pool with a strong momentum going to a decision point. Then at that decision point, that's where you can be able to place your trade. So here at Chartmaster FX, we have various decision points that we consider as powerful. The first thing that you need to consider is a valid decision point such as MPL. If there is an MPL here, or it's a double maru, or it's a QM level, then once you identify a valid decision point, you wait for the price to come to that decision point. Then you can be able to place your trade. So compression should occur first. Once your compression is over, then liquidity occurs. So usually we have different types of compression and some ways that we use in order to validate whether it's compression or not. There's a type of compression whereby price just compresses for a short time, then it compresses maybe up to this level, then it does a liquidity pool that is almost bigger than the compression, that is more than 50% of the compression. Those types of liquidity, they may not be high probability liquidity combined with compression setups. And the other ones is that it makes a kind of a, it will be compressing to this downside, but to the upside, these there will be kind of resistance that is formed, which is a BSZ. So once a BSZ is formed here, where there's a compression here, then the price makes a fake out. So that fake out will be a liquidity pool. So all those kinds of compression, we have various kinds of compression plus liquidity setups, but however in this course we are not going to go deeper about all those types of compression and liquidity. You just need to have a general know-how of what we call compression plus liquidity. So what will be happening, guys, that the price will be compressing, whereby it will be taking orders here. Some buying orders here are taken out. This one is consumed, this one is consumed, then this one is consumed. So as we are waiting for the price to cover the compression, usually what happens is that the price go to a decision point that is nearer to that compressing price movement. So once the price goes to the MPL and it goes with strong momentum here, that's what we call a liquidity pool. Once we have a liquidity pool, then the price definitely drops. So if you don't understand compression, usually what happens, there are some compressions plus liquidity that you think they are valid, but they will not be valid. So another worst case scenario that can occur is that the price will not respect this MPL and engulfs it. So you need to have a deeper understanding of what compression and liquidity is, and there are some various rules that you need to put into place in order for you to validate whether it's a compression plus liquidity or not. So the stop loss should be above the MPL or the valid decision point, and your target profit should be at the bottom of the compression. However, if you want to be more risky preservative, you can put your first target profit here before compression, because sometimes the price may come here and bounce and goes up and engulfs this MPL. So in order for you to be safe, if you open many positions, you can take some of your profits here, then you wait for the price to break into compression. Once the price breaks into compression, then we are sure that the price will come to the beginning of compression. Then here you can take your remaining profits. So guys, in general, this is what compression and liquidity is. However, for the sake of this course, as you can see that in each standard operating procedure that we are dealing with, we are only considering maybe an anatomy of one setup, which means if it's a sell setup, we deal with the sell setup. If it's a buy setup, we deal with a buy setup. So you need to also look for some buying setups. You just convert it and turn it upside down, then you can be able to take trades based on that standard operating procedure. The concept remains the same, the rules remains the same. So I just did it for the sake of us to compress the course so that I cannot take much time explaining it, because if this video is going to take 30 minutes, it means that if I use both buying and sell setups, I will take maybe 60 minutes. So I'm trying to compress the time so that I don't take much time on these price approaching strategies. And also, what is important is for you to understand the concept. Once you understand the concept, then it becomes easier for you even to apply it when it is a buy setup. So that's it, guys, for this anatomy. So the terms and conditions, you need to look for a past MPL key M level or a DM. Enter when the price reach a decision point. There should be a compression plus liquidity. entry, place a trade on the MPL zone. Stop loss is above the MPL. Target profit, the target profit should be at the beginning of compression. So those are the rules for entry. So let's go straight into the chart examples. So here guys, we are on Boom 1000 index H4, and this is a sell setup. So as you can see guys, here there is a valid MPL here. Once we have our MPL, you identify your MPL. So this is what is happening guys. If I can draw a demarcation line here, this is what you are seeing, all this futuristic price movement. You don't have anything like this on your chart. So what happens is that you see that there's a significant drop in price going to the downside. So as the price dropped going to the downside, it actually went with strong momentum, which suits momentum shift characteristics that we covered on the video on momentum shift. I will also put that video on the description so that you know what happens when you are talking about momentum shift. So basically momentum shift is that it happens when there is a strong momentum to the downside and the price moves with the slow momentum as it is going up. So that's what we call momentum shift. So we can see guys what happened here is the price approached the MPL. There was a compression that occurred here. You can see that this was compression occurring here. Once we see a compression, what happened is that instead of the price to cover the compression zone, because there was no decision point here, and as you can see that this compression, when it ends here, it was a reaction of this low is the one that actually hold the price here. Why? Because as the price moved down here, this level was ignored. Instead of price reacting to this level, it failed to react. So what happened? On the way back, the price was held by this low, or by, yeah, it was held by this low, and it went down. Once it went down, now it went up with liquidity, which is strong momentum to the upside, and it reached the MPL, and the price finally dropped and covered the compression. So the first thing that you need to do, you can put your target profit maybe here, your first target profit here if you open many positions, so that you know that once this target profit is hit, even if there is a worst case scenario where the price drops, as you can see, this price reacted here before it actually engulfed the compression zone. So what may happen is that here, as the price reacts here, the price may shoot up and even engulf the MPL zone. So taking your partial profits here is actually a good risk management that you can be able to do or to apply. Then now once you see an engulfment into the compression zone as what happened here, then you know that definitely the price is going to cover your compression zone, and you take the rest of your profits. Yeah, here we are on example number 2. On example number 2, here we have an MPL. We have an MPL here. So what happened is that the price dropped to the downside and created a low here. So once price created a low here, we can see that there was compression that occurred here. So as price was compressing, according to compression, we expect that the price should cover the compression zone. But however, there was no good decision point for the price to be held. So the price went up with great momentum, which is what we call a liquidity pull, and it came to the MPL area. Once the price came to the MPL area, the price was held by the MPL area and the price dropped. And also there was a confluence here. This is a weekly lower supply zone. So the price went to the weekly lower supply zone, then the price was able to drop. This was the upper of the supply zone. So usually guys, I do my top down analysis starting from the monthly. I draw my supply zones, I draw my demand zones, I wait for the price to come back there. Once I see that the price is actually reacting to that zone, then I can be able to see that there's confluence, like I had a confluence of an MPL, and also I knew that this was a weekly supply zone, so the price reacted to it. So usually the lower part of it and the upper part of it, they are very, very influential points that can confluence your strategy. So however, for this course we are not going to cover how you draw your supply zones from the monthly, but it's good for you to draw your demand and supply zones to the monthly and you mark them. You start with the lower part and the upper part. Usually when the price reaches there, it reacts. So yeah, so what happened here is that the price definitely dropped. So what you do, you can put your first target profit here. Once your first target profit is hit, then you wait for the price to come to this low at the beginning of the compression. Example number 3, we are on volatility 10 index H4. So what happened guys here is that we had an MPL area here, we had an MPL area, and we had a DM here, there was a DM here. So what happened was that the price dropped with heavy momentum going to the downside, which is more of a momentum shift. And when the price was approaching that MPL, it was approaching it in a form of a weak momentum. So what happened here is that the price compressed to the upside and it went down. Once it went down here, we can see that the price made an impulse move to the MPL area, and once the impulse move occurred, the price dropped. So the price dropped. So what you do here, this was a type of compression as well, where before the price makes a liquidity pull, the price makes a correction first, then it makes an impulse. So that's another type of a compression, but we are not going to go deeper on those types of CPLQ. So what you do is to put your first target profit just above here at the beginning of compression, so that you know that you are safe. Then you wait for some of your, you leave some of your positions to run up to the beginning of compression, then you can be able to take the rest of your profits here. So generally guys, this is what we call compression plus liquidity. And also guys, there's a confluence also of a momentum shift, so you need also to go and watch the video on momentum shift. Now we are on example number 4. We can see also guys that there was a strong momentum to the downside. Usually when there's a strong momentum to the downside, as the price approaches that supply zone, the price is more likely to react. And you can see guys that when the price came to that zone, the price was able to react. So there was a compression here that occurred. Once that compression occurred, we can see that the price was able to move up with liquidity going to the MPL area. Once the price reached the MPL area, the price dropped. So what you can do is to put your first profits taking here, then you leave some of your trades to run up to the compression origin. Then maybe if you also want to leave other trades, you can leave them. You may enjoy all this ride, but it's not always where you enjoy this ride. So you can see here that this depth of compression tried to hold the price, but unfortunately the price was able to continue to the downside. So guys, this is another example, and you can see that there's a confluence, there's a kind of a momentum shift, and there was a compression plus liquidity to the MPL area. So this is how you can be able to trade uh, compression plus liquidity. So usually when that compression and liquidity is combined with the momentum shift, it actually makes your trade more probabilistic, because there are more chances that that trade is going to be successful. Why? Because there is a confluence. That's why I encourage you guys to understand the full course, because once you see some things doing a confluence, it actually helps your trades to be of great having a great possibility of being successful. Let's go to example number 5. Here guys, we are on crash 1000 index on M30. What happened here guys, we have an MPL area here. You draw your MPL, and what happened here is that the price dropped with heavy momentum to the downside. So once you see this condition guys, it actually strengthens this MPL. It means that this MPL is of greater strength, and we are more likely to see the price reacting to this MPL and failing to engulf it, and we are more likely to see the price dropping. So once you draw your compression here, you have to calculate the angle here. If it's less than 45 degrees, then it's good to go. Usually when it's greater than 45 degrees, then it might be a problematic thing. So once you validate that your compression is good, you wait for the liquidity pool. Once the liquidity pool okay, then the price, you put your entry, then the price reacts to that MPL. So this is a kind of an MPL, and also we can also call it a Quasimodo level here. So these things sometimes they confluence each other. And here guys, we have our stop loss just above the MPL area. So as you can see, as the price was compressing, you can see this guy was ignored here when the price came down. And once you see an ignored demand level, mostly when the price comes back to that level, it actually reacts. So that's where you see this reaction of price. So usually compression plus liquidity mostly occurs when we have a demand that is ignored here. So where the price makes a correction to the downside before making an impulse move to the upside, and we see that that's what happened here. The price was able to break this finally, and the price went with heavy momentum to the upside to the MPL area, and definitely the price dropped. So usually this is the characteristics of the movement of the price guys. What happened is that as the price comes here to the liquidity level where liquidity started, the price usually reacts to some point, and you can see guys that we had a kink here. This kink was ignored when the price went down, and when the price started to rise up, it was held by this kink because it was ignored. So this is the theory of ignored levels guys, but however we are not going to look at ignored levels in a deeper spectrum in this course, but I think you are starting to have a general idea of what I am talking about. So guys, this was a good point to see that the market was more likely to drop. So you take your partial profits here, you wait for others to run up to beginning of compression. So as you would see price now moving to the upside, you don't have any hesitation, because you know that we have a kink here and we have kind of a hidden base. So this was a strong zone to hold the price, and this was a kind of an ignored level. Once guys, there's an ignored level, because the theory says the market should react to this, because as the market was going up, this was what we call demand, and we are expecting that the price should react on the demand somewhere, but it failed, it ignored it. So as that demand was ignored, as the price reaches there, on its way back, it actually drops most of the time, because it was ignored in the first place. So that's where you see some flipping. That is the theory behind the flippy zones. That's how flippy zones occur most of the time. And you can see here guys, we also have a kind of a flippy zone. Why? Because as the price was dropping, in theory we expect that this demand was supposed to hold the price, and maybe the price should go up, but it failed to. So what happened is that when the price is coming back to this demand, then the price actually holds the price is held by this demand, and the price drops. So this is how some flippy zones okay guys, those who want to know how flippy zones okay. So finally guys, this is what we call the level of break of compression. Once there was a break of compression here, then we were sure that the price was going to drop, going to our target profit, and definitely the price was able to come to our target profit guys. So these are the examples concerning compression plus liquidity. I hope guys you have learned something from this tutorial. You need to practice more, you need to practice more. So in conclusion, a compression plus liquidity that is combined with momentum shift gives you a better edge than a compression plus liquidity that does not have momentum shift. So you can see guys the confluence of these things. That's why I like you to have a full comprehension of all the standard operating procedures. I know that the standard operating procedures, there are many, but however, even you may be able to specialize, like you want to specialize in the Quasimodos or the diamonds, or you want to specialize in significant demand, engulfment, or it is the Ken, whatever you want to specialize in. But however, you need to have a basic understanding of all the other standard operating procedures. That is going just to help you, so that when you see a confluence occurring, it gives you a better edge to place that trade and become profitable. So thank you guys for watching this video. Don't forget to like, subscribe, share, and hit the notification bell, so that you don't miss any of the coming content. So as you can see guys here on the chart master formation, the CPLQ is the gunman guys, it's the gunman guys. Once you understand the compression guys with liquidity, I can tell you the goals are going to be at the back of the net. You just see goals getting scored here. So compression, there's a kind of a compression plus liquidity that is combined with the 3 drive guys, not with the 3 drive, with the fake out, I mean guys, with the fake out. Compression plus liquidity with the fake out. So you can see the confluence of these things guys, they help you to make it in this trading career. So what I need you to master is that you need to master all the price approaching strategies. The price approaching strategies guys, it's a must. You need to know them. You need to know the 3 drive, you need to know compression, you need to know compression plus liquidity, you need to know fake out, you need to know impactful patterns. You need to know momentum shift. All these guys, they are powerful. You need to know them, guys, because they are entry-based strategies. However, you may not, even if you don't specialize in the claw, but you specialize in the Quasimodo, then it's fine. You know that once a Quasimodo is formulated, you will be looking now either for a fake out or a compression or a 3 drive or a CPLQ, because usually the Quasimodo itself cannot be able to score goals because it's a defender. It's on the defensive end. You will be having a goalkeeper before the QM, so you need to find some strikers, you see. So when the Quasimodo is formulated, most of the time, maybe sometimes there's a fake out that okay, you take that trade. Sometimes there's a compression that okay, you take that trade. Sometimes there's a 3 drive, or sometimes it's a combination of a fake out and a 3 drive, or it's a combination of a fake out with compression. You see, that's why I want you to understand all these guys. You need to understand the strikers, guys. You need to know them very, very, very well. So yeah, guys, if you want also to join our community, you can join us on Telegram. I also put the link so that you can be able to learn more and see what other mentees are doing at Chartmaster FX, guys. Don't forget to put the work, guys. Put the work. Develop as many flashcards as you can. Backtest your strategies. Come up with your own formation based on the Chartmaster main strategy, because I know maybe most of you may not be able to comprehend everything, but come up with a strategic plan for your own trading style, combining some of these things that I have presented in this course. So yeah, as usual, your boy Chartmaster signing out.